Let's get right into the data. We're always hearing these big numbers thrown around about the economy. GDP, inflation, growth rates, they're everywhere, in every headline. But what do they actually mean? Today, we're going to cut through all that noise, demystify these key indicators, and figure out the story they're really telling. So you see it all the time, right? The headline flashes. Economy grew by 3% this quarter. And yeah, that sounds good. But how does that number actually connect to your job, your savings account, or the price of milk? It's a totally fair question. And the answer, well, it's a lot more interesting than the headline lets on.
These indicators aren't just abstract figures for economists to argue about on TV. No, they have very real-world consequences that ripple through literally every part of our lives, from the decisions we make with our own money to the policies governments put in place. So why should you really care? Because this stuff influences everything. I mean, on a personal level, it helps you figure out if now's a good time for a huge purchase, like a house, or how to invest your money for the best return. And looking bigger, these are the numbers that drive government decisions on taxes. They signal what's happening in the job market, and honestly, they give you the tools to actually understand what's really going on behind the news.
Okay, to get started, we've got to understand the two most essential metrics. Think of these as the economy's vital signs, like its heartbeat and its temperature. Let's break them down one by one.
First up, we've got gross domestic product, or GDP. Put simply, this is just the total value of everything, all the goods, all the services, produced inside a country's borders in a certain amount of time. The speedometer analogy is perfect here. It tells you exactly how fast the economy is going. Higher GDP, it means more stuff is being made and sold.
The second vital sign is inflation. This is just the rate that prices for everything are going up. And when that happens, your purchasing power goes down. The shrink ray for your wallet idea is dead on. The same amount of cash buys you less than it used to. It can happen for a couple of reasons. Either everyone's trying to buy stuff and there isn't enough to go around, or it just gets more expensive to make the stuff in the first place.
Okay, now here's where the data gets really interesting. GDP has a cousin you probably haven't heard of, GNI, or gross national income. So while GDP tracks what's made inside a country, even by foreign companies, GNI tracks what's made by a country's own people and companies, no matter where on the planet they are. For most countries, the difference is tiny, like 1%. But check out a place like Ireland, which has a ton of multinational corporations. Back in 2001, its GDP was a staggering 19% bigger than its GNI. That is a massive distinction when you're trying to figure out who's actually cashing in on all that economic activity.
All right, so definitions are one thing, but this next part, this is, without a doubt, the most critical piece of the puzzle. You have to be skeptical of this data, because numbers can be presented in ways that are technically true but incredibly misleading. Let's look at 3 of the most common data traps.
So imagine it's early 2006. You see this headline, U.S. economy is cooking, growing at a solid 4.8% annual rate. That's the official number. Looks pretty good, right?
But wait, a little while later, that number gets revised up to 5.3%. This is the first trap. Initial economic data is almost always a preliminary estimate. They get updated as more info rolls in. So just remember, the first number you hear is rarely the final word.
And that brings us to trap number 2, the base effect. This one is a classic. Just look at this table for UK orders. If you compare the third quarter to the second, it looks like orders dropped 2.2%. That's a negative story. But that second quarter was unusually high. What happens if you compare the third quarter to the first quarter instead, a more normal starting point? Well, suddenly, orders are up 2.6%. It's the exact same data, but you get 2 completely different headlines just by changing the starting point.
And here's another one you see all the time, the confusion between annual and annualized figures. An annual change is simple, right? It just compares one whole year to the year before. But an annualized change is different. It takes a tiny snapshot, like 1 month, and then projects it out for a full year. And this is how a pretty small 1% rise in a single month can get blown up into a huge, dramatic-sounding 12.7% annualized growth rate. It's a textbook way to make small changes look massive.
So with all these potential traps out there, how do you get a clear picture of what's happening? Honestly, it's simpler than you might think. You just have to build the habit of asking a few key questions every single time you see a statistic.
And here they are, your 3 critical questions. First, who made this number? Is it a neutral government agency, or is it a private group with an agenda? Second, when is this data from? Are we talking about a single month, a full year, and are they comparing it to a normal period? And third, will this number be revised?
always remember that first reports are just estimates. Asking these 3 simple questions will immediately give you an edge and let you cut right through the noise.
And we'll end on this thought. Look, economic data gives us powerful tools to understand what's going on, but it is not a crystal ball. The goal isn't to just swallow the numbers you're fed, but to question them. So the next time you see a headline with some big economic number, don't just accept it. Ask who, ask when, and ask what might change. That's how you find the real story hiding in the stats. Stay disciplined.